Hello and welcome, everybody. Welcome back or welcome to Sectors Made Simple. Our goal today is to talk about what is going on right now and not really approach it from the standpoint of should we be worried that we're going into a recession? Instead, we're going to talk about what we do if we are going into a recession at any point in the future. Because the reality of it is, we want to learn how to invest for a lifetime. And learning how to invest in a recession is going to be a skill that we're all going to need at some point, and some investments fare better than others. So today, we're going to cover a few key investments that are best ready to handle bad markets as well as good markets. Really quick before we get into it, I need to quickly mention our disclaimer. Everything I'm covering today is not meant as investment or financial advice. The goal in me sharing this information with you is so that you can make more informed investment decisions. So, any examples we give are not recommendations, and past results don't guarantee future performance. That's why it is very important for you to do your own research prior to making any investment decisions. Diving right in, we're going to talk today about how we invest in recessions and something that goes hand in hand with that are bad markets. So we're going to talk about what bear markets are and what recessions are, how they're similar and how they're different. Then we're going to go into how and why they impact the stock market and how we can adjust our investment strategies, both how we're investing and what we're investing in to better handle a recession or a bear market. Then we're going to get into what types of investments perform the best during bear markets or recessions, ways that we can find strong companies, and plenty more. So let's get started with the big question. So if you're just here to find out the answer, you can get it over with right now. Should we worry as investors about recessions? No. As investors, we care more about the stock market. And in fact, a recession is not something we should fear. As investors, it is almost something that we should, for the lack of a better term, keep a close eye on optimistically. I'll cover why in a little bit. That's the cliffhanger to keep you around, is you shouldn't be worried. Stick around to find out why. But before we get into that, let's actually cover what a recession is. A recession is a type of economic change. Our economy is constantly ebbing and flowing, growing and shrinking, and that's just how it goes. We are never just standing still. So we are always going through expansion, meaning our economy is growing, or recession, our economy is shrinking. This is often called the economic cycle. We go from expansion to slowdown, to recession, to recovery, to expansion, and so on. But there's one little thing that I don't like about that traditional example and the name of it as a cycle. It doesn't usually go in a circle. We don't go full circle just to end up where we were before. To explain that a little bit more, I'm going to give you all the very simple, just basic number that we can look at and talk about when we're thinking of a recession, called GDP, or Gross Domestic Production. How much stuff is the United States making? GDP is a very simple way to try and talk about, is our economy growing or shrinking? If GDP is going up, we consider ourselves to be expanding. If GDP is shrinking, we consider ourselves to be receding. So this is the one number, not so much to rule them all, but it is one of the most simple numbers that we can look at to get an idea of what's going on. And the reason before that I was mentioning that I don't like the term economic cycle is that it's not a circle that brings us back to step one. Instead, GDP has historically trended positively over time. We have a period of expansion, rapid growth, slowdown into a recession, and then we go back up and back down and back up. But typically, we are always growing past where we were at the beginning of a recession, and traditionally, our expansions last longer than our recessions. If, for example, one of my favorite graphics for this is Fidelity. Fidelity has a market cycle indicator or status, and I want to see if I can pull that up for you, because they really hit the nail on the head in terms of talking about or giving us a better idea of what this cycle really looks like. What we see is that the vast majority of this chart is mid to late term expansion. Recession is just this tiny little sliver over here on the right. And by the way, if you're worried about looking where we are on this chart, something I'll tell you right now, anyone that tells you that they know exactly where we are in the economic cycle is probably not telling you the full story. Because if we looked at this a year ago, we were entering a recession. If we looked at this 6 months ago, we were in the middle of a late recession. And we've been going backwards in this cycle. So really, recession or not is anyone's guess. Fidelity thinks we're going through late expansion right now. Your mileage may vary. But the important takeaway here is that expansion lasts longer and is much larger than recession. So what actually makes a recession a recession? This word means something, because you've probably heard of the more extreme example, a depression. Both of these are two types of just economic slowdown. But what actually makes a recession be called a recession? Well, we can go to NBER, or National Bureau of Economic Research. They really need to think of some better acronyms. This is a non-government organization that provides the official start and end dates of a recession. But they don't just say March 18th of 2025, today is the beginning of a recession. It's typically, they'll look at the history and say, okay, 3 months ago, we started a recession. 2 months ago, the recession ended. They're very much looking back in time to put a start and an end date to that recession. They're not going to call it as it's happening. Now, NBER looks at a few different factors, and unfortunately, they're a little secretive as to how much weight they put on each one of these, but we're going to simplify it down just so that we understand the basics. They look at production, how much stuff are we making? Income, how much are we getting paid? Employment, who has jobs? And spending, who is taking their money and putting it back into the economy. These 4 things, which has a much better acronym, PIEs, gives us a more complete picture of the health of the US economy. If we're producing a lot of stuff and there's people buying a lot of stuff, that means we're going to need a lot of employees. Employees means they're getting paid. Them getting paid means that they go and invest that money back into the economy, and the cycle repeats. That is what we look at when we think about a recession. It's not just GDP, it is a number of different economic data pieces. When we really boil it down too, this list is much more than just 4 pieces of information. We have personal expenditures, we have non-farm payrolls, we have unemployment rate. That stuff is a conversation for another day. Or if you follow us on TikTok or here on YouTube, we do post YouTube shorts covering some more of these smaller economic updates as they happen. But for today, all we need to know, a recession is determined by NBER, and they use PIEs as a way of figuring it out. But what actually causes it? We know what it is, we know the symptoms, but we don't know the cause. The cause can really be a handful of things. These are just a few of the examples. Inflation. One thing that will really hurt spending is inflation. If we're all of a sudden having to pay 10% more for our groceries than we did last month or last year, you're less likely to spend. Or if you need to still buy those groceries, you're less likely to spend on that vacation or on that new car or the new furniture. This inflation can cause a recession either accidentally, which can happen, or intentionally, let's call it. I put it in air quotes because I don't think anyone wants to get up there and say, well, a recession is just going to happen, right? But either way, the important part here is that a recession sometimes will just happen because we're trying to fix the problem of inflation, and one of the symptoms of a recession is either deflation or a decrease in inflation. So, for some people, they look at a recession as a way of fixing a bigger problem. Whether you agree with that or not, that's a conversation not for today. Another one is a lending crisis, credit issues, borrowing money that we can't pay back, and then banks or institutions defaulting. This can and does happen. We've seen a few banks over the past few years fail, and anyone that's a little bit older would probably remember the Great Recession of 2008, where that entire Great Recession was started by a lending crisis. Another one, global events. The two most recent recessions that we've had were 2007 to 2008 and on. The beginning was late 2007, 2008. And then 2020. So what can cause a recession? Could be a lending crisis or a catastrophe, a outbreak of something. I want this video to get picked up by the algorithm, so I'm not going to mention what, but hopefully you get the idea. March 2020 was the most recent recession and also the shortest recession in history. Kind of interesting. But the last one, and the one that I think is most relevant today, consumer fears. If consumers are scared about a recession, they might make it so. Let's go back to what the different indicators of a recession are. Production. Well, that one we don't have to think about. Income. If people are losing their jobs, or if they're not getting paid as much, or they've lost contracts for work, they're making less income. Employment. Mass layoffs could cause unemployment to skyrocket, one of them. But the big one is spending. If consumers are worried about inflation being a possibility, they're less likely to spend their money. They're going to start saving it. If consumers are worried about if a recession is going to happen, they're going to start to panic a little bit. And a large part of what can cause a recession are those consumers panicking. Now, again, whether you think that's happening right now or not, different story. There is a lot of different economic data coming out to show consumers are losing their confidence, but consumer spending is still high, as are retail sales and many other sales-related and spending-related things. So let's now ask the question, are we currently in a recession? No, we're not in a recession. Now, to dive into that a little bit more, there are some indicators that are pointing to a recession starting. GDP forecast. Again, does Enber directly use GDP? Probably not. But for the average person, it's the one number that they're going to look at and say, 2 consecutive quarters of GDP losses is the sign of a recession. So they're going to pay attention to that. Right now, The Atlanta Fed, which is the Atlanta Federal Reserve, currently forecasts GDP for this quarter to be a loss of 1.8%. That is a negative number, meaning it would be the first of the 2 consecutive quarters. The second one is one that I don't really want to dive into much today, but it's called the bond yield curve. This idea that if you're going to lend me money, if you lend me money for 2 months, you might only want 4% interest. But if you lend me money for 20 years, you're going to want 5%. I'm holding your money for longer, right? You're going to want more interest. That's how it should work. But if you were really worried about what's going to happen over the next 3 months, so all of a sudden, you don't want 4%, you want 5%, 5.5%. It's possible that these shorter term bonds, these shorter term IOUs, actually have higher yield than the longer term one. When this happens, we call this a bond yield curve inverting, and traditionally it's been one of the most accurate leading or predicting indicators of a recession. Right now, it's inverted, just barely. But the big one, declining consumer confidence. We have seen consumer confidence drop like a rock over the past 2 months. What's interesting, though, is that it is very dependent on political party. Not getting into politics, this is the data. There has been almost zero change in how Republicans are viewing the economy, a moderate change in how independents are viewing the economy, and a significant change, a significant loss in how Democrats are viewing the economy. So even there are a lot of differences between political groups thinking one thing or another about objective economic data. So those are the indicators that would lead me to say we're getting close to a recession. Some points, though, say that we're not. Retail sales are growing. Unemployment is still low. We've never had a recession in history with an unemployment rate below 5%. We're at 4.1%. That is well within what is still considered normal. And then the last one is increased consumer spending. Again, consumers might be getting less confident about the economy, but they're still spending money in it. Now, let's get away from the economics and get into the world of investing. Should we care? Why have I spent the first third of this webinar talking about a recession? Does it really matter? Kind of. It kind of does. Because investing is all about growing our money. And our goal is to pick investments that we expect to grow in value over time. But during recessions, company profits decline. If GDP is going down, that means companies are producing less stuff. They are losing money. People are losing their jobs. There's a lot of economic challenges that come with a recession, but in terms of investments, it also means that the companies are going to be hurt. When a company is hurt, share price goes down. So investors try and outsmart everything. What they'll do is they'll try and predict if a recession is coming. They'll say, I think that there is a 50% chance that there will be a recession. So if I'm thinking there's going to be a recession, and recession means stocks go down, you're going to do the most obvious thing. You're going to take your money out of stocks before they go down and either put it somewhere else, put it under your mattress, whatever it is. But you're going to take your money out of the stock market, which then means if there is now more supply of people selling and not as many people buying, price is going to go down. Now, all of a sudden, the price is going down. Your friend next to you sees what you're doing and wants to join in. So they also sell, and someone also sells. And the market ends up causing its own decline before the economy does. But what do they move their money to? We'll come back to that. Because right now, I want to focus instead on this crash idea. This idea that investors will worry about a recession and lead to the market declining. And to do that, we need to talk about the bulls and the bears. When investors sell out of stocks, they're selling off what they own, we'll start to see the market decline. And this decline will almost always happen before a recession even begins. Because the investors want to be out. They want to be on a plane to Hawaii before that recession begins. Now, we set a couple of levels for how far down a price goes, and we try and give them names. So if it falls 10%, we consider this to be a market in correction. It was going up, and it's corrected back down. If you've been following the stock market at all the past few weeks, I've got something very interesting to show you. You'll probably be familiar with the fact that the stock market, and by stock market I mean the S&P 500, has been going down. Now, the really interesting thing here, the previous high, the all-time high of the S&P 500 ETF SPY was on February 19th. The the low since then was on Thursday, March 13th. That's a loss of 10.04%. Now, Google's not perfect. They're not giving me the high of the day and the low of the day. But what this is showing us is that 10% mark means something. Because as soon as we hit that 10% correction line, the market bounced back up. And now it's kind of in a holding period until the Federal Reserve meeting tomorrow. But the important part is that we see what happens when the market tests that correction line. It does matter. That name means something. But very often, the market doesn't stop at the correction line. It continues going down. And if it falls 20%, it is now considered to be in a bear market. This is the boogeyman of stock investors, or for stock investors. It is the thing that they fear because it's this feeling that everything is going down. But what it really means, when we put this all back in context, is that bear markets usually happen before recession. So if we're sitting around waiting for a recession to begin before we start to sell out of our stock, bad news, the bear market's already been happening probably for a few months. Which is what we're seeing right now. In my opinion, many people aren't worried about we are in a recession right now. They're worried that we could be in a recession in the next few months, which is why we might be seeing stocks declining as a result. But all things pass. Eventually, in the middle of a recession, investors feel that the economy might be starting to show signs of life again. And they're going to do the same thing in reverse. They're going to try and predict when the market's going, or when the economy is going to recover. And they see that all of these stocks have gone down 20%, 30% in price. Like going to the clearance section at Walmart. All of a sudden, everything's on discount. You buy it up, whether you think you want it or not. So, you buy up all the stocks on a discount. Now, all of a sudden, a lot of people are buying. Stock prices begin to go back up. So, what this means is that bear markets usually come before recessions, but bull markets begin in recessions. The best periods in the stock market begin during recession. So going back to that question we asked earlier, as investors, should we fear recession? No, we should fear bear market. Because if anything, a recession is going to be the period where that bull market begins. And if we're smart and savvy investors, we are able to find when that bull market begins. But that doesn't mean we need to sit on our hands until then. Really quickly, before we dive into the real fun part of today, which is the different investment options for bear markets, I want to talk about the market cycle. We just talked about the economic cycle of expansions and recessions, but we have the market cycle as well. Bull markets lead to bear markets, which lead back to bull markets. And we've learned that these two cycles go hand in hand. A bear market will begin before a recession begins, and a bull market will begin before expansion begins. So, what that means is, again, we shouldn't fear recessions because bull markets begin in recessions. But also, bear markets begin before recession, which is why learning what types of investments perform the best in bear markets is honestly more helpful than learning what types of investments do well in recession. So, what do we do? What do we invest in during bear market? Let's take a look. I quickly want to remind you, investing is more than just about stocks. There are many types of investments out there. Stocks, cryptocurrencies, NFTs, Pokemon cards, your friend's business. You can put your money in so many places. And as long as you feel that there is value to be gained, the value of that money is going to go up over time, probably an investment. A good investment or not for me to decide. But the important thing for us to know is that if a bear market is happening, there are types of investments that would actually perform really well because they aren't impacted by a bear market. The bear market is stocks. There are other things that do perfectly fine, even if a bear market is happening. So we're going to talk about a couple of them, and I've tried to put them in order of lowest average risk to highest average risk. Again, past results don't guarantee future performance, so we can't just say, this is always the lowest risk, this is always the highest. So the first one we'll cover are treasury securities, treasury debt securities, then dividends, stocks, and finally, stock options. Let's get into it. Starting off with debt securities. Debt securities are also called notes, bonds, bills, but they're all talking about the same thing. They are a kind of IOU, where you lend your money to someone else for a set amount of time. So you might lend me $100 for 2 years. And then I will pay you interest on that money. So if you lent me $100 for 2 years and asked for 5% interest, I would give you $5 at the end of year 1, $5 at the end of year 2, plus your $100 back. So this is a very common way that governments, state, municipal level, and even federal will try and raise money. What they will do, well, yes, companies do offer bonds. Most investors are looking at these treasury securities. Because the way that they work is that you will lend money to the government, and the government tells you, we'll pay you back. Trust us. Now, that seems like a pretty good idea. And honestly, it is. In my opinion, bonds are a great type of investment to consider because they are very defensive. While there's no such thing as a zero risk investment, that is unfortunately impossible, there are things that are near zero risk. And treasury, bills, notes, bonds, the name changes depending on the length, but all of these are considered to be near zero risk because what they do is they provide an interest rate. That interest rate for most securities won't change. So if you start off at 5%, it will be 5% for the entire duration of that security. And you're not stuck with it for 10 years or 5 years. In fact, you can go out and you can buy or sell these treasury bonds to and from other investors. So they're an investment just like anything else. Just because you're getting a 5-year bond doesn't mean you're stuck with that bond for 5 years. Now, to give you a couple of numbers for us to talk about, 20-year bonds right now pay 4.625% interest annually. So every year for 20 years, they will pay you for a $100 bond, $4.62.5. 2-year offer 4%. So as we see, shorter term thing, lower interest. Longer term thing, higher interest. In a good system, that's how it would work. So that guarantees you that 4.625% interest until the end of those 20 years. Now, that means that you will get paid that amount. The value of it does not really go up or down. The only thing that will go up or down is if you resell it. But that interest rate is locked in. So think about this. Right now, if we look at inflation, the CPI inflation number is 2.8%. So 2.8%, we're just going to think super short term here, just to keep the numbers easy. 2.8% inflation, 4% interest. That means as long as I have faith that the government is going to pay me my interest, then I'm making $4 per year, 4% per year, while inflation only went up 2.8%. Near zero risk, and we're profiting money, and we're doing better than inflation. But what happens if all of a sudden, at the end of this year, inflation jumps to 8%? Now, we are still making that 4%, but our money is losing more value than it's gaining. So that in some regards is risk, because it's possible that inflation goes up more than our yield does. But the other risk is that if the Treasury Department defaults on their debt and doesn't pay. This has technically never happened. There was one time in 1979 that their computers went down and that the payments were delayed, but they still paid them. There has been 4 times in the past that the US has failed on their debt, but it's never been on Treasury securities, been on other things. The only way that that could happen is if the debt ceiling, which is how much debt the government can take on, if that doesn't get lifted and we go into a problem where the US defaults on its debt. So as long as the debt ceiling is good, we're fine. Let's talk about dividends. Dividends are a very interesting and lesser known component of stocks, because most people just think of stocks as profiting if the share price goes up. You buy it for $100, goes up to $110, you made $10. Perfect. But that's only one way to make money through buying shares of a company. Many companies will offer what are called dividends. These dividends are a percent of the profits or the earnings from that company and are given back to the shareholders. They say we made $1 million, we have 1,000 shares, every shareholder gets $1,000. They're not really that big, I just wanted some nice numbers for us to work with. Most companies that offer dividends will pay them out quarterly, so once every 3 months. And these are often reported as the dollar value. So it would be a dividend of $1, and then we translate it to the percent. So a $1 dividend on a $25 stock would be a 4% dividend. Now, here's where things get really fun. Dividends are typically given as a cash payout. You get paid directly from this company. But many people own their stock in a brokerage account, and most brokers, for primarily the big companies, will offer another choice. What you can do is instead of taking the cash and just putting it in your pocket, you can reinvest your dividend back into more shares of that same company. This is called a dividend reinvestment plan, or DRIP. These, in my opinion, can be extremely helpful in bear markets and recession. Here's why. If a company pays a $1 dividend when its share price is $50, that's a 2% dividend. So if we reinvested it, it gives us 2% more shares. If they still paid a $1 dividend when their share price was $40, now for every share, I'm getting 2.5% instead of 2%. So the dividend yield has gone up because their share price went down. So if I reinvest that, now I'm getting more shares for the same amount of money. So I'm reinvesting even if that share price goes down because I'm getting more shares for the same dividend payout. And this can really help us for when the profits, or rather when the price of that investment starts to go back up. Again, bear markets, much like recessions, are shorter and are smaller than expansions and bull market. So the hope is that the recession doesn't last very long, the stock doesn't go down a lot in price, and we're still getting those dividends. We're still getting more shares of the company. So when the price begins to go back up again, we've got a lot more invested in that share for it to go back up with. Now, not all companies are made alike when it comes to dividend. Some will only offer dividends if they have a really good quarter. Others won't offer dividends at all. And some, especially the ones that we're interested in here, have shown a history of providing consistent, meaning they don't miss payments, and increasing, meaning they pay out more every single time in dividend payments for years. There's two main lists, the dividend aristocrats and the dividend kings. Dividend aristocrats are S&P 500 companies that have 25 years or more of increasing dividend payments. While the dividend kings are any US company with 50 years or more of increasing dividend payments. You might think that gives us a very short list of companies to work with. There's more than you think. As of today, March 18th, 2025, there are 69 aristocrats and 55 kings. Pretty nice. These companies have provided dividends through good markets, bad markets, recessions, and more. Keep in mind how much history has happened over the past 50 years. We have seen numerous bull markets, numerous bear markets, the Great Recession, and these companies have weathered them all. They're still around today. They have shown themselves to continue to provide value. Their share price has typically gone up over that period of time, as have their dividend payments. Jonathan, funds are also an option for investing. Yes, keep in mind with funds, a fund is not some magic investment that just beats the market. They will still invest in something. So, as long as what they're investing in is performing well, then yes, they are a great option for bear markets as well. Now, I want to take one of the dividend aristocrats and put it under the microscope together. Procter and Gamble, or P&G. I'm going to pretend that we bought Procter and Gamble at the beginning of the Great Recession, January 1st, 2008. If we had invested $10,000 into Procter and Gamble in 2008, that investment would be worth just about $30,000 today. We've tripled our money. But that's if we just pocketed the dividends. If we reinvested the dividends, we would now have $38,707, meaning we've made over a quarter more on our investment because we chose to reinvest Procter & Gamble's quarterly dividends. This example is not strange. There are tons of examples of companies that have offered strong returns throughout bear markets and recessions. Have they profited? No. You can't just magically beat the market because you pay good dividends. But what I can say is, on average, these dividend yielding companies have performed better than the S&P 500, and through providing dividends, have allowed investors to grow their shares over time, helping those good periods to feel even better, and the bad periods to be weathered a little bit easier. So, this is just one example of a company that offers regular dividends, and again, there are 69 aristocrats and 55 kings for us to consider. That's a lot. I don't know about you, that's a lot more than I want to deal with. So, if our strategy here with these is to not eliminate losses, because again, there's no such thing as a zero risk investment. Our goal is just to keep some money in the stock market. We know that bear markets will end eventually. So we still want to have one foot in the pond for when it does. So what instead we can do is find stocks that can weather those bear markets a little bit better, and through dividends offer us some profits even if the share price isn't going up short term. Again, with P&G, the S&P 500 fell 56.8% throughout the Great Recession, and it took until September of 2012 to recover those losses. Procter & Gamble fell only 30%. And I know what you're thinking, 30% is still a hell of a lot of money. I agree. Keep in mind, this was the worst bear market we have had since the Great Depression, but it's also the most recent example. So please take that with a grain of salt. But the point here is that it was less impacted than the S&P 500, and by September of 2012 had recorded a gain of $1,300. So while the market had just pulled itself out of its rut, we were already looking at a 13% profit. Not too bad. So choosing the right king or the right aristocrat can be a little tricky. And again, we're looking at the best of the best here. These are either 500 of the largest companies in the US stock market that also pay dividends, or have 50 years or more of dividend payments. And again, not all the dividends are the same. Some will offer more, some will offer less. And their stock prices can be different, and their stock prices can change in different amounts. It can get a little bit overwhelming. So it can be really helpful to research and find a list of the top companies on these lists today. My suggestion, good old Google. Google top dividend kings, current month, current year, and you'll probably find a couple of lists. But even then, you're still left with a handful of companies to choose from. So can we narrow it down even more? So that we're all doing this together, I'm going to go really quick and type that in. Best dividend kings, March 2025. And I'll pull this over here for us all to look at. Take your pick. There's tons of different articles that we can find. One that I believe that I used to prep today's example, not because it's the one that I would recommend, just it's one of them that I had found. I believe it's not this one. It was one that picked 5. This one. SureDividend.com. Sure. 5 best dividend kings today. Stepan Co., Gorman Rupp, SJW, PPG, and Pepsi. Cool. 5 companies. I can work with that. To narrow it down even further, that's where a tool like Sectors Made Simple can actually come in. We have created a lot of different investment tools to help beginners and advanced traders alike find opportunities simpler in the market. One of our tools, called Custom Matrices, is an easy way to compare a group of companies. And it's very useful for doing exactly this. We can score these 5 dividend companies to find which ones are the strongest right now, because the highest count is the strongest company, based on historical results. So let's do an example. What I've done is, to make sure that we can just continue today's webinar fluidly, I've gone through our tool and I've already created that custom matrix for us. So what you'll notice is right here, we have Dividend Kings, March 2025, with those 5 companies. Typically, these take about 5 to 10 minutes to run. I wanted to save us that. So if we click View and scroll down, we get a list of the companies. We have long-term strength, short-term strength, and then the combination of the two, total count. And if we sort it by total count, we find GRC is the top company within this list. So in a couple of seconds, we've gone from searching to find the top companies to going here, creating a matrix with those 5 companies, and sorting to find the biggest number. And that's an informed investment decision. We've done our research. We know that these companies are among the best when it comes to providing consistent dividends, and we've compared their prices to find which ones have the best returns right now. And that's it. Again, do you need this tool to do that? No, it's more work. Our goal here is not to be, hey, this is the only way for you to do this. I want you to walk away with knowledgeable information you can use regardless of if you have a subscription or not. But I do want to have the opportunity to showcase how our tools can save you time and help you with that last step of the decision-making process and help you make those informed investment decisions simpler. So we will revisit a couple of the other tools later on. So now we've talked about dividends, let's talk about stocks. It might seem silly for us to think about stocks when the entire stock market is going down. But it doesn't move as a unit. We don't see that if the S&P 500 is going down, it's dragging everyone else with them. Certain types of companies will handle recessions better than others. For example, larger companies typically can handle recessions and bear markets better than small cap companies. Also, certain types of businesses, known as sectors, will perform better during recessions and bear markets. For example, defensive sectors such as healthcare, utilities, and energy typically perform better during these down periods compared to something like technology or discretionary. Discretionary is simply the I wants in life. It's your luxury products, your department stores, your online retailers, and your vacations and cars. Typically, when you're cutting back on your spending, you're not going to be buying that new car, you're not going to be buying that new computer. But you still need your healthcare, still need your gas, and you still need your power. which is why defensive sectors do perform better during those down periods. But again, even within these groups, there's always some stars that shine brighter. There are always a few individual companies that defy the odds and can post profits even while the majority of the market is losing. And what this lets us do is continue actively investing. If our goal is we want to invest because investing's fun, it's really fun to have a hobby that can make you some money, we're going to want to continue investing. And we're not going to want to put it on hold for 8 months until the market starts to show signs of life again. So instead, we just need to look a little bit more because those opportunities do exist. Unfortunately, there's not really a good way of doing this with free tools. There are ways out there. For example, Arnulfo was talking about funds. You can find funds that are performing very well. You can look at something like FinViz and find what companies have been profitable over the last month or the last week. There are ways to find these companies, but again, I don't think that there's a single way that makes it as easy as our S&P 500 screener, because that is probably the simplest way to find those market leaders. To do it, we need to talk a little bit about resistance. Our goal is that we want to find companies that aren't just getting lucky and had a good day. That's the problem with most of the information out there for investing in single companies when the rest of the market is going kaput. It's really hard to differentiate a good couple days from actually a strong company. So to do this, there's this whole idea known as resistance, where we look at previous highs that the stock price had reached and try and find companies that are breaking those old highs and entering new uncharted territory. So that's what we'd want to look for. We'd want to look for the strongest companies that have recently gone on these resistance breakouts, with the hope that that positive trend continues and we can join in on that ride. And you might be thinking, the market's been tanking. We've already talked about the fact that the stock market has gone down by 10% in the past month. Surely there's not many companies on that list. Out of the 500 S&P 500 companies, yesterday, 31 of them went on these resistance barrier breakouts. These happen way more than you think, and if you know where to look for them, you'll find them very quickly. So the strategy that I want to cover here uses our S&P 500 screener. What we can do is filter by these breakout resistance signals and check the up arrow to make sure the price is still going up. And then if we sort by signal date, we can find the companies that went on those signals most recently. Can't always say there's going to be 31 of them every day, but the goal is that we have more than one or two for us to consider. Each company's percent tells us its relative strength. So higher numbers mean more strength. A percent of 85 means out of the 500 companies in the S&P, beating 85% of them. So it doesn't just tell us this company is on a buy signal. It also tells us this company is on a buy signal and it's getting absolutely wrecked by all of the other companies. Versus this company is on a buy signal and it is one of the strongest in the group. Take your pick. So let's go and do that together. Let's quickly head back over to the dashboard and reload it because I closed it by accident. And we're going to go here to S&P 500 screener. Sort by breakout signal. So those are those resistance barrier breakouts. Direction is going to be up arrow. And we're going to sort by signal date by clicking on the title so we can see the most recent signals. And again, you didn't believe me. 31, sorry, 31 companies have gone on buy signals yesterday. Some are fairly weak. This company is only beating 30% of companies in the S&P. This company is beating 75%, 77%, 85%. Now we're getting a good qualified list of companies. So again, in a few seconds here, we've been able to find the companies that are defying the odds and are going on those breakouts right now. But 31 might be too many, so can we narrow our search? Yes. We can filter by sector to show only companies in the top sector. So if, for example, we felt like, and in other webinars, I do go into much more detail about how to find the top sector, but let's just say utilities was the top sector right now. We could sort, so now we only see companies in the utilities sector. Or another way, create a custom matrix. Go through, say, okay, CB, CB, ELV, High, Netflix. Okay, I like that group. Go plug that into a custom matrix, compare them head to head, and see which one is performing the best. We're making very informed decisions with minimal effort because most of the work has already been done for us. And that's really the goal. The last thing I want to talk about is kind of the final step. This is what many investors work up to being able to do. Options. Options are a type of investment known as a derivative investment. No, we're not taking you back to calc class, don't worry. Derivative here just means it's an investment based on another investment. So you could have an option for Apple, or for Tesla, or for Microsoft, or for gold. It is based on another investment. And what they are just contracts. It is an agreement that says that I will allow you to buy or sell shares to me of that company for a set price on or before a specific date. So it might be that you will buy 100 shares of Microsoft from me for $500 a share before Friday. That would be an option. And when you're trading that option, you're not trading Microsoft. You're trading that contract. And because of that, and because one contract usually controls 100 shares, options have significantly higher risk to reward than the investments they control. For example, 100 shares of Microsoft right now would cost you $38,300. An option for Microsoft would currently cost you $3,440. So you can take $3,440 and technically have control of $38,352 worth of Microsoft. No, those numbers are actually real. So options provide some crazy risk to reward. But how does that make them defensive? Why would options be something to consider if we're in a bear market? Well, it can be defensive in two ways. The first are put options, this idea of shorting the market. What you can do is you can buy an option that allows you to sell shares at a certain price. And through the magic that is options, you profit, you make money if the price of that investment goes down. So if you bought a put option and the price of the stock went down, you profit as a result. So you could buy a put option and make profit through a bear market. But the other option, pardon the pun, are day trading options. Like I mentioned before, High risk to reward means that it's a lot quicker to see results. A stock price could move 1 to 3% in a day. 5% movement in a day is a lot. 5% movement in an option is nothing. It is very possible to see an options price change by 15, 20, 25, even up to 100% of its value in a few minutes. So because of that, we can profit. Where if we're following these prices very closely, you could buy an option and sell it 5 minutes, 15 minutes later, and potentially make 25, 30% profit. But you're also risking a significant portion of that investment. Really, you're risking all of that investment. So options are a very high risk, high reward place. But options traders love bear markets. They love bull markets. They want any market except a market going nowhere. Because when there's a lot of uncertainty, if we're not sure if a bear market or a recession is going to happen, well, the price is going to be going up and down a lot more. And in every one of those ups and downs, there's an opportunity for them to make money. If they think it's going to go back up, they buy a call, a buy option. If they think it's going to go down, they can buy a put option. So if option trading is where you want to go with things, a bull market and a bear market offer the same opportunities. The area that will offer the most opportunity is an uncertain market. And I think we can all agree right now the market is 100% uncertain. So when fears around a recession or a bear market increase, that's where option traders can profit. So to bring everything back together, can we invest in bear markets? 100% we can. Whether you are entirely risk averse and your goal is just to minimize your losses as much as possible, there are choices for you. If you want to go to the other end of things and your goal is to maximize your profit, there are opportunities for you there too. And as with any type of market, good market, bad market, and everything in between, diversification is key. Don't put all your eggs in one basket is a very common saying, and for good reason. Because of that, it is so important for us to know that we have choices on where we can put our money. We can put some of our riskier funds into options while we put some more of our defensive stuff into drips or into treasury securities. Everything we talked about today can have a place in an investment portfolio. There are different levels of risk and different levels of reward. And we've covered how we can take each one of these and start using them to invest simpler throughout the possibility of a bear market, recession, and everything in between. Now, I've covered just a few of the examples today. I know it's funny to say these are just examples of investments that make sense for a bear market, but I hope that at least one of them has resonated with you and is something you want to learn more about. Now, our goal has always been to create investment education. We want to be able to present this information to you so that you don't have to worry as much. There's already enough fear out there. Don't let our investments be another source of that. But again, we are committed to trying to help you invest simpler and to create tools to help you invest simpler as well. So if you're interested to find out how we can help you personally invest simpler, please reach out to us. If you want to learn more about our education, our tools, or how we can help you reach your investment goals, we're here. There are two amazing ways to reach out to us. The first, as a thank you for making it to the end of the webinar, is you can schedule a one-on-one meeting with me. It is always amazing to get to talk to investors and hear from you all what you're finding to be a way of investing simpler, and if you're already finding ways that you like to invest, to see how our tools can help you invest even simpler. So reach out, set up a one-on-one meeting with me. You can go to sectorsmadesimple.com/one-on-one. The link will be down in the resources of this or the description of this video, and schedule a one-on-one meeting with me. Otherwise, if you don't want to have a chat face to face, or you just want to keep it simple, you can always email me at support@sectorsmadesimple.com. Thank you all so much for joining us. It was such a pleasure to get to hopefully put some of your worries aside when it comes to a recession. Put your worries aside when it comes to what we do with our investments if we fall into a bear market. And remember that investing can be made simpler with the right education, right knowledge, and also the right tools. Thank you all so much for joining us today. We hope to see you all back very soon here on YouTube or over on our TikTok, Instagram, and Facebook and YouTube, where we post regular short content as well. Thank you so much. Take care.